Did you know you can use debt to avoid taxes? Sounds too good to be true, right? Well, allow me to clarify that it's not a magic wand, nor is it a shady scheme. Instead, it's a concept deeply rooted in the intricacies of our tax system. But before we delve into that, let's debunk a few tax myths that might be clouding your judgment. Firstly, taxes aren't just a way for the government to steal your hard-earned money. They serve a crucial role in maintaining public services and infrastructure. Secondly, the idea of the more you earn, the more you pay isn't entirely accurate. Our progressive tax system is designed to ensure fairness and proportionality, meaning the percentage of tax you pay increases with your income, but not in a one-to-one ratio. And lastly, avoiding taxes isn't synonymous with tax evasion. There are legal strategies to minimize your tax liability, and using debt is one of them. So hang tight as we dive into this intriguing concept that could potentially save you a fortune. To understand how debt can help you avoid taxes, we first need to understand what debt is. At its simplest, debt is money borrowed from one party by another. It's like a promise you make to repay the borrowed amount, often with an added cost, known as interest. This interest is the price you pay for the privilege of using someone else's money. There are various types of debt. Consumer debt, for instance, includes credit cards, car loans, or personal loans. Then there's mortgage debt, which is borrowed to buy a home. Business debt, on the other hand, is money borrowed to start or grow a business. These are just a few examples, but there are many other types of debt as well. Now let's talk about how interest works. When you borrow money, you agree to pay it back with interest. This interest rate can be either fixed, meaning it stays the same over the life of the loan, or variable, meaning it can change. The total amount you pay back is the principal, which is the original amount borrowed, plus the interest accrued over the life of the loan. So how does debt tie into taxes? Well, in many countries, the interest you pay on certain types of debt is tax deductible. This means you can subtract the amount of interest you've paid from your taxable income, effectively reducing the amount of tax you owe. This concept is key to understanding how debt can be used as a tool to minimize taxes. This is not to say that taking on debt is necessarily a good or bad thing. Like any financial decision, it has potential benefits and risks. The key is understanding how to use it wisely and responsibly. Debt can be a powerful tool in your financial arsenal, but it's crucial to understand how it works before you dive in. The more you know about debt, the better equipped you'll be to make informed decisions about your financial future. Now that we have a better understanding of debt, let's explore how it can be used to avoid taxes. So how exactly does one use debt to avoid taxes? Well, the concept is actually quite straightforward. You see, in many jurisdictions, the interest you pay on debt can be deducted from your income before your taxes are calculated. This effectively reduces your taxable income, and therefore the amount of tax you owe. Consider this scenario. You're a business owner, and you take out a loan to expand your operations. The interest you pay on that loan, it can be written off as a business expense. This lowers your overall income on paper, and subsequently, the amount of tax you're required to pay. Or let's say you're a homeowner with a mortgage. The interest you pay on that mortgage, yes, you guessed it right, it can often be deducted from your taxable income. This can result in significant tax savings over the life of your loan. This strategy isn't just for businesses and homeowners either. Investors can also utilize this tactic by borrowing money to invest in income-producing assets. The interest paid on the borrowed money can often be deducted from the income generated by the investment, thus reducing the overall tax liability. But before you rush off to borrow money, it's crucial to remember that this is a strategy, not a one-size-fits-all solution. It requires careful planning and consideration of your own financial situation. Sounds simple, doesn't it? But remember, there's always a catch. Before you rush off to take on more debt, there's something you must consider. While debt may be a tool for tax reduction, it's a double-edged sword. The potential risks and downsides are real. Increasing debt can lead to heightened financial risk and could potentially trap you in a cycle of borrowing. It's not about recklessly piling up liabilities, but about strategic financial planning. So while using debt to avoid taxes can be an effective strategy, it's crucial to approach it with care and professional advice.